Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Ian Williams of Charteris Treasury. Ian, welcome back to the Keiser Report.
Thank you.
Ian, let's talk about precious metals. You called for silver to get to $150 by December of 2015. Is this still the target? What's going on?
It is actually, yeah. I didn't quite expect it to come down this far. It's come back on the back of gold selling. Gold's come down on the back of some 500-ton liquidation from gold ETFs, mainly by North American investors. Most of that gold seems to have been bought by Asians, mainly in China and Thailand and out in the Far East.
So is there a transfer of gold from the west to the east?
Absolutely, yes.
Hundreds and hundreds of tons?
Yes.
What's the speculation now? How many tons does China own? Officially, they own 1,000 or so tons. What's the scuttlebutt? How many do they really own?
Well, that's the central bank ownership. Then you got most of this buying recently has been by private individuals, which doesn't get counted in that. But I mean, with the costs that have escalated in the mining industry, if you were to find a new gold deposit today, if you borrow money and whatever and build a mine, you're probably talking $1,500 an ounce. So what's going on at the moment is that all these American ETF individuals are selling gold $300 below its replacement value, and the Chinese and most of the Asians are buying gold $300 below their replacement value. Well, guess who's going to win?
Let me ask you something. The replacement value, in other words, you're saying that the miners, their cost per ounce of gold is between $1,300 and $1,500 an ounce.
To build a new mine.
To build a new mine.
Yeah,
Even now, the current mines, and I just read something recently, the cost of pulling gold out of the ground is now the cost is something around $1,100, $1,200, $1,300 an ounce.
Yeah, but some mines it's $600, $700. It depends on the mine because the infrastructure is already in place.
Has the cost been going up?
Yeah, because
how sharply has cost been mining? My point is this. The central banks are saying there's no inflation in the economy. They're pursuing deflation, policies to fight deflation. However, the cost of mining has gone up 100% at least over the past 5 or 6 years. So where's the deflation there? Shouldn't the cost, therefore, of mining be deflating if the central banks are truthful?
Well, I think from here on it will be, because it's a typical sort of boom-bust mentality. So during the expansion phase, the shareholders of these mining companies were egging the management growth at all costs, and they were all expanded at the same time. So they were all headhunting people, paying quite huge wages, paying up for equipment. So a lot of the cost escalation was due to that. What's happening now is a lot of these CEOs of the big mining companies have all been fired for basically wasting shareholders' money, and they've now been replaced by new people, and the first thing the new guy does is cancel all the marginal capex projects. So that investment cycle in mining is now going into reverse, which is actually going to be very favourable for the mining companies' free cash flow, but of course it's going to potentially lead to shortages in the sort of 2016, 2017 onwards.
Okay, so gold is typically trades inverse with the dollar, and the dollar is now trading up. It's got a lot of strength. All the technical people that I'm looking at are saying dollar on a technical basis is very strong. On a fundamental basis, it's strong. So am I correct to assume that for this gold and silver rally to find some footing and to break out and start moving to the upside, it'll be concurrent with a dollar topping out? Is that
not necessarily?
Not necessarily.
No, absolutely. Because if you look between the year 2000 and the year 2011, gold went up every single year, and it went up. It didn't matter what currency it was priced.
Okay, so let's talk technical analysis for a second, because Charteris in your work is primarily technical.
Well, we do a lot of stuff.
A lot to do with technical analysis, and technical analysis would be, let's say, unlike fundamental analysis, where you're looking at the management, you're looking at the macroeconomic trends. Technical analysis looks at the price charts pretty exclusively to look at repetitions and chart patterns and this
cycles as well.
And cycles. Yeah. So in the case of silver, okay, here you have a chart. You know, I'm not a chartist. I'm not a technical expert, but I think anyone looking at that chart would say this chart looks pretty awful. So how do you get to that $150 price target by the end of 2015? What technical patterns have we violated? There's usually some terminology that people bring in, whether it's a head and shoulders, reverse head and shoulders, a candlestick, breakout, something. Technically, give us some tech speak here.
Okay. Well, the main reason we think this is apart from the fundamentals, i.e. gold and silver effectively being below their replacement cost, on the technical side, the main reason we like silver so much is there's almost perfect 10.5 year cycle in silver that bottoms around the years ending in 2/3. So you had a major low in 72, a major low in 82, you had a major low in 93, so it was 10.5 years then, and another major low in 2002, and we think that the 2012, 2013 is the bottoming of the 10-year cycle. And a lot of the sell-off you've seen in the last 3-6 months, if you look at Elliott wave type stuff, where you've got your C wave, which is a capitulation sell-in wave, a lot of the stuff, the market's heavily oversold at the moment. All the technical indicators fit in with the cycle low, in that what you're seeing is whether the C wave traditionally just wipes out all the stale bulls. And then what you're left with is a complete clean sheet of paper, and then you're off again on the new bull run.
All right, so you refer to it Elliott wave or C wave. Again, it's a technical tool, technical analysis tool. And for some watching, they'll say, well, that doesn't sound really like you can buy into this type of forecasting. However, since so many people do, it can become a self-fulfilling prophecy, because there's a huge number of hedge funds out there that actually just look at technical analysis, and if they fall in and start buying according to that, then it happens. But I want to change gears for a second, because last time you were here, you called pretty much the top in the bond market.
Yes.
And that, is, of course, was quite prescient.
Yes.
The bonds topped out.
Yes.
And now where are we in the bond market?
Well, again, if you look at cycles, take the gilt market, for instance, there's a 30, 36-year cycle in the gilt market. That's now topped out. So you had 30 years of upswing in bonds, gilts and US Treasuries, and we're now potentially going to have 30 years of downswing. Now,
interest rates going higher now for at least, for
a sustained period of time.
A cyclical...
Absolutely, yeah.
Now, all the tracker rates for mortgages in the UK, they'll be starting to be adjusted upwards every quarter now going forward. Because they're interest rate sensitive.
Yes, but the bond market, when you're talking about the bond market, we're really talking about 5-year bonds, 10-year bonds, 30-year bonds, 50-year bonds. Doesn't necessarily mean that overnight interest rates are going to move. They'll be the last to move. What will happen is the bond, all the yields further down the curve will all move up. And then at some stage, I don't know, next year or whenever, the Fed will get round to maybe raising interest rates and tapering off its QE program. But the first phase of this will be in the longer dated maturities. It won't necessarily mean that cash overnight deposits start raising.
If you had a tracker rate, would you get out of it?
Basically, you're going to look at whatever your mortgage basically comes off, you're going to be looking at higher financing charges when it's rolled over now, because some are fixed to 5 years, some are fixed to 10 years. There's so many different types of mortgages. I mean,
Okay, fair enough. Okay, let's move on to now you, in your latest newsletter, just to follow up on this bond theme, it's titled Bonds, the $80 trillion gorilla in the room. So, it's funny because the gold and silver markets have sold off, and there's a lot of talk about that. But if you compare it to the bond market sell-off, particularly last Friday, the dollar volume paper losses in these bond sell-offs eclipses whatever anyone lost in gold and silver by a factor of probably at least of 30 or more.
Well, that's correct. I mean, in size terms, you're comparing a mackerel to a whale. In terms of, I mean, you look at an average pension fund, they might have 50, 60, 70% in bonds. They might have 1% in gold. So even if gold were to halve, in terms of what it affects a traditional pension fund, it maybe knocks the overall fund by 0.3, 0.4 or something. If the bond market halves, it decimates the value of the entire fund. So the movement in the bonds is far more important. It's a miles bigger market. So any percentage losses there are going to, if it's $80 trillion bond market, which we think is the size of the market, if yields back up to their historic lows, because we're at 300-year lows at the moment, effectively someone somewhere loses $2.5 trillion. That's the magnitude of the losses that you're looking at in bonds. Well, you're not looking at that's. As I said, it's comparing a mackerel to a whale. There's nothing like that sort of money being lost in the gold market.
Right. People say that there was a bull market in gold it's over. However, less than 1% of global investable assets are in gold.
That's correct.
So that's not a bull market. Bull markets have a lot higher ownership characteristics. Where in bond market, of course, it's especially in the last few years during rates coming down, we've had a massive rush into bonds.
Yeah, that's the bubble. Yeah.
No, people, one might have 40, 50, 60% of their money in bonds.
Absolutely.
So a move like we've seen in the last week, you're talking about real pain.
Oh yeah, and this is only the start. There's going to be a lot more to come. I mean,
Now, in 1994, there was a bond sell-off, pretty vicious.
Yes.
So you're looking for something of that magnitude or bigger?
Oh no, it's going to be. I mean, '94 was just like a six-week blowout. I mean, it was pretty painful. I mean, long gilts went from 8% to 10% in 6 weeks, but it wasn't in exactly the same way that this pullback in gold. It was halfway up the ladder pullback. It wasn't the big bear market in bonds. It was just a pullback, because 8% is still quite good value, but it still didn't stop them going to 10%. And then what you had when that sell-off, that 6-week sell-off was over, the bull market resumed,
right,
and it didn't pick up. And I think this is what's happening in gold as well. You've had gold went up every year from 2000 to 2011. Every single year it went up. It's now had a big shakeout. We don't think this is the top in the bull market, because one of the boxes, as you rightly say, is participation in the market. If there's only a 1% participation rate, it's a box you tick that you haven't seen the top yet. So we think what you're now going to see in gold and silver is another multi-year bull market. I mean, it's a tremendous investment opportunity for anyone to sell bonds and buy precious metals and mining companies.
Right. I mean, for those people who watch the show regularly, as they know, we started recommending silver at $5 and gold at $400.
Yeah.
So we've been really following this for quite some time. I want to spend the last minute or so just touching on the banks, because banks, of course, they're capitalized with bonds.
Yes.
And we just went through a huge banking crisis where the credit froze, the banks had to be bailed out. It triggered a massive transfer of wealth from the top 80% to the top 1/100th of 1%. You know, okay, so if the bond market's in a bear market now, banks, therefore, are...
well, they're the major players in the bond market.
We can see another bank failure?
Well, obviously, if the bond market goes into reversal, more than one bank is going to suffer some quite severe losses if the market pulls back. And I would think that the ones that get it right, like Goldman's did in the 2008 crash, that get short will be in the minority, and the ones that end up owning these bonds will probably be in the majority. So pick any name out of the hat, but someone somewhere is going to take a bath.
All right, Ian Williams, thanks so much for being on the Keiser Report.
Okay.
Well, that's all the time we have for this episode of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Ian Williams of Charteris Treasury. If you'd like to get in touch, tweet us at Keiser Report. Till next time, Max Keiser saying bye, y'all.